Day 31. Let's continue with the fourth chapter, mutual funds and other investment companies. We are starting with fees and mutual fund returns. 1 second. The rate of return on investment in a mutual fund is measured as the increase or decrease in net asset value plus income distributions, such as dividends or distributions of capital gains expressed as a fraction of net asset value at the beginning of the investment period. We denote the net asset value at the start and end of the period as NAV 0 and NAV 1 respectively. Then rate of return is equal to NAV 1 minus NAV 0 plus income and capital gain distributions divided by NAV 0. For example, if a fund has an initial NAV of $20 at the start of the month, makes income distribution of $0.15 and capital distribution of $0.05 and ends the month with a NAV of $20.10, the monthly rate of return is computed as NAV 1 minus NAV 0 plus income and capital distribution by NAV 0. That's $20.1 minus $20 plus $0.15 plus $0.05 divided by $20, which is equal to 1.5% as the rate of return. Notice that this measure of rate of return ignores any commissions such as front-end loads paid to purchase the fund. On the other hand, the rate of return is affected by the fund's expenses and the 12b-1 fees. This is because such charges are periodically deducted from the portfolio, which reduces the net asset value. Thus, the investor's rate of return equals the gross return on the underlying portfolio minus the total expense ratio. Example 4.3, fees and net returns. See how expenses can affect the rate of return. Consider a fund with $100 million in assets at the start of the year and with 10 million shares outstanding. The fund invests in a portfolio of stocks that provide no income but increases in value by 10%. The expense ratio, including 12b-1 fees, is 1%. What is the rate of return for an investor in the fund? The initial NAV equals to 100 million divided by 10 million shares, which is $10 per share. In the absence of expenses, fund assets would grow to $110 million and NAV would grow to $11 per share for a 10% rate of return. However, the expense ratio of the fund is 1%. Therefore, $1 million will be deducted from the fund to pay these fees, leaving the portfolio worth only 109 million, NAV equal to 10.9. The rate of return on the fund is only 9%, which equals the gross return on the underlying portfolio minus the total expense ratio, which equals the gross return on the underlying portfolio minus the total expense ratio. Okay. Fees can have a big effect on the performance. Table 4.2 considers an investor who starts with $10,000 and can choose among 3 funds that all earn an annual 12% return on investment before fees, but have different fee structures. The table shows the cumulative amount in each fund after several investment horizons. Fund A has a total operating expense of 0.5%, no load, no 12b-1 charges. This might represent a low cost producer like Vanguard. Fund B has no load but has 1% in management expenses and 0.5% 12b-1 fee. This expenses has no 12b-1 charges but assesses 8% front and load on purchases. Note the substantial return advantage of low cost fund A. Moreover, the differential is greater for longer investment horizons. So let's look at the table. Table 4.2. impact of costs on investment performance, cumulative proceeds, all dividends reinvested. Fund A, Fund B, Fund C. Um, so the initial investment in Fund A is 10,000, same in Fund B and C. Oh, in Fund B it's 10,000, but in Fund C it's 9,200. Because Fund C has 8% load on purchases and 1% expense ratio. Okay, Fund A no load on with 0.5% expense ratio. So in 5 years, all three funds earn annual 12% return on investment before fees. So 11,200, or this will be like some formula or something. As we can see, lower costs, more value in a longer term horizon, just in general also. So no load, 8% load on purchases and 1% expense ratio. Concept check 4.2. The equity fund sells Class A shares with a front end load of 4%, Class B shares with 12B1 fees of 0.5% annually, as well as the back end load fees that start at 5%, fall by 1% for each full year the investor holds the portfolio until the 5th year. Assume the rate of return on the fund portfolio net of operating expenses is 10% annually. What will be the value? What will be the value of $10,000 investment in Class A and Class B shares if the shares are sold after 1 year, 4 year, 10 years? Which fee structure provides higher net proceeds at the end of each investment horizon? So I'll have to check this because it's a little complicated for me. I haven't understood the expense ratios and stuff. Okay, so the equity fund sells Class A shares with a front end load of 4% and Class B shares with 12B1 fees of 5.5% annually, as well as back end load fees that start at 5% and fall by 1% for each full year the investor holds the portfolio until the fifth year. Assume the rate of return on the fund portfolio net of operating expenses is 10% annually. What will be the value of a $10,000 investment in Class A and Class B shares if the shares are sold after 1 year, 4 years, 10 years? Which fee structure provides higher net proceeds at the end of each investment horizon? So initial investment is 10,000. Portfolio return net of operating expenses is 10% annually. Class A front-end load 4%, Class B 12B1 fees 0.5% annually, back-end loan starting at 5% in year 1, decreasing by 1% each year, each full year until year 5, 0% after year 5. Class A shares, net investment after front-end load 10,000 minus times 0.96, 9,600. Future value formula FVA equals to 9,600 times 1.10 to the power t, where t is equal to the number of years. After 1 year, FVA equals to 10,560. After 4 years, FVA equals to $14,055.36. After 10 years, it'll be equal to $24,899.92. Class B shares, no front end load, but annual expense is higher due to 0.5% 12B1 fees. Net annual return 10% minus 0.5%, which is 9.5% annually. Back end load maximum 5. Wait 1 second. Maximum 5 minus t minus 1, 0. For t less than equal to 5, 0% for t greater than 5. Future value before back end load is, only considering the 12B1 fees, is 10,000 times 1.095 to the power t. Proceeds after back end load, if applicable, would be future value before load times the appropriate percentage. So back end load starts 5% year 1. So if you're taking out the money out of the portfolio in year 1, it will be 10,000 times 1.095 to the power 1 times 5%, times 0.95. Yeah, so that'll be, yeah, so it'll be basically okay, here's the answer. After 1 year, back end load 5%, future value before load 10,950. Future value, final future value is 10950 times 0.95, like I said, which is equal to 10,402.5. Same thing for 4 years and 10 years. We calculate the values and then we compare the 3 net proceeds. For the first year, the higher proceeds are in Class A, which has 10,560, and Class B has 10,402.5. Second, after 4 years, Class B has higher proceeds with $14,089.07, outdoing the $14,055.36 of Class A. After 10 years, for the 10-year investment horizon, high proceeds are Class A at $24,899.92, compared to the Class B's $24,782.27. So conclusion, for short term, 1 year, Class A wins, back end load on B is high. For medium term, 4 years, Class B wins, lower back end load and avoided initial 4% load. For long term 10 years, Class A wins again because Class B's ongoing 0.5% annual fee drag outweighs the benefit of no initial load once the back end load expires. Okay, let's continue. Although expenses can have a big impact on net investment performance, it is sometimes difficult uh, for the investor in a mutual fund to measure the true expenses accurately. This is because of the practice of paying for some expenses in soft dollars. A portfolio manager earns soft dollar credits with a brokerage firm by directing the funds straight to that broker. On the basis of those credits, the broker will pay for some of the mutual fund's expenses such as databases, computer hardware, or stock quotation systems. The soft dollar arrangement means that the stockbroker effectively returns part of the trading commission to the fund. Purchases made with soft dollars are not included in the fund's expenses. So funds with extensive soft dollar arrangements may report artificially low expense ratios to the public. However, the fund may have paid its broker needlessly high commissions to obtain its soft dollar rebate. The impact of the high trading commission shows up in net investment performance rather than the reported expense ratio. Taxation of mutual fund income. Investment returns of the mutual funds are granted pass-through status under the US tax code, meaning that taxes are paid only by the investor in the mutual fund, not by the fund itself. The income is treated as pass-through to the investor as long as the fund meets several requirements, most notably that virtually all income is distributed to shareholders of funds. Short-term capital gains, long-term capital gains, and dividends are passed through to investors as though the investor earned the income directly. The pass through of investment income has one important disadvantage for individual investors. If you manage your own portfolio, you decide when to realize capital gains and losses on any security. Therefore, you can time those realizations to effectively manage your tax liabilities. When you invest through a mutual fund, however, the timing of the sale of securities from the portfolio is out of your control, which reduces your ability to engage in tax management. A fund with a high portfolio turnover rate can be particularly tax inefficient. Turnover is a ratio of trading activity of a portfolio to the assets of the portfolio. So it measures the fraction of the portfolio that is replaced each year. For example, $100 million portfolio with a 50 million in sales of some securities and purchases of other securities would have a turnover rate of 50%. High turnover means the capital gains or losses are being realized constantly, and therefore the investor cannot time the realizations to manage his or her overall tax obligations. Turnover rates in equity funds in the last decade have typically been around 50% when weighted by assets under management. By contrast, a low turnover fund such as an index fund may have a turnover as low as 2%, which is both tax efficient and economical with respect to trading costs. Concept check 4.3. An investor's portfolio currently is worth $1 million. During the year, the investor sells 500 shares of FedEx at a price of $160 per share and 3,200 shares of Cisco at a price of $25 per share. The proceeds are used to buy 1,000 shares of IBM at $160 per share. What is the portfolio turnover rate? Question B, part B. If the shares in FedEx originally were purchased for $140 each, and those in Cisco were purchased for $20, and the investor's tax rate on capital gains income is 20%, how much extra will the investor owe on this year's taxes as a result of these transactions? So investor's portfolio is currently worth $1 million. During the year, investor sells 500 shares of FedEx at a price of $160. So that's $80,000 from FedEx. FedEx 80K Then you have 3,200 shares of Cisco at a price of $25 per share, which is also 80K dollars. Proceeds are used to buy 1,000 shares of IBM at 160 per share. So IBM, so that's 160K. What is the portfolio turnover rate? So portfolio turnover means 50 million in sales and purchase of other securities. So I mean, I would say the yeah, I would say it's like 16%. 16% makes sense. So yeah, I would say 16% only. Yeah, because the total value is 160K, which is being shuffled around basically. Yeah, sure. And then if the shares in FedEx originally were purchased for 140, yeah, 140, okay. 500 times 140, 70K. Cisco at price 20. Cisco is 3,200, 20. Mm, 16,000. There, 16,000. Huh. And there's some mistake. 1 second. Oh, okay. Sure. 500. So yeah, okay. So he made $10,000 on FedEx and $16,000 on Cisco. It's pretty good. It's like a 26K return. It's pretty good stuff. 140, so 70. Cisco was 264. 70. 134, and he made off with 160. That is 26, yeah. So he made $26,000 return. How much extra will the investor owe on this year's taxes as a result of these transactions? So he made $26,000 and his tax bracket on capital gains income is 20%. So 0.2 times 26,000, 5,200 will be the answer. Pretty good stuff. Let's move on to ETFs, exchange traded funds. Exchange traded funds, ETFs, first introduced in 1993, are offshoots of mutual funds that allow investors to trade index portfolios just as they do shares of stock. The first ETF was the Spider, a nickname for SPDR, or Standard & Poor's Depository Receipt. That's a cool nickname. Which is a unit investment trust holding portfolio matching the S&P 500. Unlike mutual funds, which can be bought or sold only at the end of the day when NAV is calculated, investors can trade spiders throughout the day, just like any other share of stock. Spiders give rise to many similar products such as diamonds, based on Dow Jones Industrial Average, ticker DIA; cubes, based on Nasdaq's 100 index, ticker QQQ; and webs, world equity benchmark shares, which are shares in the portfolios of foreign stock market indexes. By 2016, about $2.1 trillion was invested in 1,600 US ETFs. Table 4.3 panel A presents some of the major sponsors of ETFs, and panel B gives a very small flavor of the types of funds offered. Figure 4.2 shows the rapid growth in the ETF market since 1998. Until 2008, most ETFs were required to track specified indexes, and ETFs tracking broad indexes still dominate the industry. However, there are dozens of industry sector ETFs, and as figure 4.2 makes clear, a significant number of commodity, bond, and international ETFs. Figure 4.3 shows that ETFs have captured a significant portion of the assets under management in the investment company universe. Barclays Global Investors was long the market leader in the ETF market, using the product name iShares. Since Barclays 2009 merger with BlackRock, iShares has operated under the BlackRock name. The firm sponsors ETFs for several dozen equity index funds, including many broad US equity indexes, broad international and single country funds, the US and global industry sector funds. BlackRock also offers several bond ETFs and few commodity funds, such as ones for gold and silver. For more information on these, go to www.ishares.com. So yeah, that is a lot of ETFs. Here we have ETF sponsors and products. BlackRock, State Street, Vanguard. US indexes: spiders, SPY, S&P 500, diamonds, DIA, Dow Jones Industrial, cubes, QQQ, Nasdaq 100, iShares, Russell, Total Stock Market, Vanguard, Wilshire 5000, Energy Select, Spider, XLE. So all these are pretty interesting stuff. Spiders, diamonds, and cubes. As we can see, the ETFs have grown over time a lot. So yeah, this is a pie chart of mutual funds, ETFs, closed-end funds, and UITs. Investment company assets under management, $2015 billion. So we can see 15.6 trillion in, what is this, mutual funds is 15.6 trillion. 2 trillion is exchange trade funds. 261 billion is closed end funds, and UITs is 94 billion. More recently, a variety of new ETF products have been devised. Among these are leveraged ETFs with daily returns that are targeted multiple of the returns on an index, an inverse ETF which moves in the opposite direction to an index. Another return innovation is the actively managed ETF, that is, like actively managed mutual funds. It attempts to outperform passive indexes. However, until recently, these funds have had to report portfolio holdings on a daily basis, which makes it easy for competitors to take advantage of their buying and selling programs. This requirement has severely limited the growth of the segment on the market. 2014, however, the SEC gave permission to Eaton Vance to offer an actively managed non-transparent ETF that is required to report its portfolio composition only once each quarter. Same frequency at which mutual funds disclose their portfolio holdings. Other companies such as BlackRock have also indicated interest in sponsoring non-transparent ETFs. At the end of 2015, there were 134 actively managed ETFs registered with the SEC. Other, even more exotic variations are called synthetic ETFs, such as exchange traded notes (ETNs) or exchange traded vehicles (ETVs). These are nominally debt securities but with payoffs linked to the performance of an index. Often, that index measures the performance of an illiquid and thinly traded asset class. So, the ETFs give the investor the opportunity to add that asset class to his or her portfolio. However, rather than invest in those assets directly, the ETF achieves this exposure by entering a total return swap with an investment bank, in which the bank agrees to pay the ETF the return on the index in exchange for a relatively fixed fee. These have become controversial as the ETF is then exposed to risk in that in a period of financial stress, the investment bank will be unable to fulfill its obligation, leaving investors without the returns they were promised. ETFs offer several advantages over conventional mutual funds. First, as we just noted, a mutual fund's net asset value is quoted, and therefore investors can buy or sell their shares in the fund only once a day. In contrast, ETFs trade continuously. Moreover, like other shares, but unlike mutual funds, ETFs can be sold short or purchased on margin. ETFs also offer a potential tax advantage over mutual funds. When large numbers of mutual fund investors redeem their shares, the fund must sell securities to meet the redemptions. This can trigger capital gains taxes, which are passed through to and must be paid by the remaining shareholders. In contrast, when small investors wish to redeem their position in an ETF, they simply share their shares to other traders with no need for the fund to sell any of the underlying portfolio. Large investors can exchange their ETF shares for shares in the underlying portfolio. This form of redemption also avoids a tax event. ETFs are often cheaper than mutual funds. Investors who buy ETFs do so through brokers rather than buying directly from the fund. Therefore, the fund saves the cost of marketing itself directly to small investors. This reduction in expenses may translate into lower management fees. There are some disadvantages to ETFs, however. First, while mutual funds can be bought at no expense from no load funds, the ETFs must be purchased from brokers for a fee. In addition, because ETFs trade as securities, their prices can depart from NAV, at least for short periods, and these price discrepancies can easily swamp the cost advantage that ETFs otherwise offer. While those discrepancies typically are quite small, they can spike unpredictably when markets are stressed. Chapter 3 briefly discussed the so-called flash crash of May 6, 2010, when the Dow Jones Industrial Average fell by 583 points in 7 minutes, leaving it down nearly 1,000 points for the day. Remarkably, the index recovered more than 600 points in the next 10 minutes. In the wake of this incredible volatility, the stock exchanges cancelled many of the trades that had gone off at what were viewed as distorted prices. Around 1/5 of all ETFs changed hands that day at prices less than one half of their closing price, and ETFs accounted for about 2/3 of the cancelled trades. At least two problems were exposed in this episode. First, when markets are not working properly, it can be hard to measure the net asset value of ETF portfolio, especially for ETFs that track less liquid assets. And reinforcing this problem, some ETFs may be supported with only a very small number of dealers. If they drop out of the market during a period of turmoil, prices may swing wildly. Next up, 4.7. mutual fund and investment performance, a first look. So, we noted earlier that one of the benefits of mutual funds for the individual investor is the ability to delegate management of the portfolio to investment professionals. The investor retains control over the broad features of the overall portfolio through the asset allocation decision. Each individual chooses the percentages of the portfolio to invest in bond funds versus equity funds versus money market funds and so forth, but can leave the specific security selection decisions within each investment class to the managers of each fund. Shareholders hope that these portfolio managers can achieve better investment performance than they could obtain on their own. What is the investment record of mutual fund industry? The seemingly straightforward question is deceptively difficult to answer because we need a standard against which to evaluate performance. For example, we clearly would not want to compare the investment performance of an equity fund to the rate of return available in the money market. The vast differences in the risk of these two markets dictate that year by year, as well as the average performance, will differ considerably. We would expect to find that equity funds outperform money market funds on average as compensation to investors for the extra risk incurred in equity markets. How then can we determine whether mutual fund portfolio managers are performing up to the par given the level of risk they incur? In other words, what is the proper benchmark against which investment performance ought to be evaluated? Measuring portfolio risk properly and using such measures to choose an appropriate benchmark is far from straightforward. We devote all of parts 2 and 3 of the text to issues surrounding the proper measurement of portfolio risk and trade-off between risk and return. In this chapter, therefore, we will satisfy ourselves with the first look at the question of fund performance by using only very simple performance benchmarks and ignoring the more subtle issues of risk differences across funds. However, we will return to this topic in chapter 11, where we take a closer look at mutual fund performance after adjusting for differences in the exposure of portfolios to various sources of risk. Here we use as a benchmark for the performance of equity fund managers the rate of return on the Wilshire 5000 index. Recall from chapter 2 that this is a value weighted index of essentially all actively traded US stocks. The performance of the Wilshire 5000 is a useful benchmark with which to evaluate professional managers because it corresponds to simple passive investment strategy. Buy all the shares in the index in proportion to their outstanding market value. Moreover, this is a feasible strategy for even small investors because the Vanguard Group offers an index fund, its total stock market portfolio, designed to replicate the performance of the Wilshire 5000 index. Using the Wilshire 5000 index as a benchmark, we may pose the problem of evaluating the performance of mutual fund portfolio managers this way. How does the typical performance of actively managed equity mutual fund managers compare to the performance of a passively managed portfolio that simply replicates the composition of a broad index of the stock market? Casual comparisons of the performance of the Wilshire 5000 index versus that of a professionally managed mutual funds reveal disappointing results for active managers. Figure 4.4 shows that the average return on a diversified equity funds was below the return on the Wilshire index in 27 of the 45 years from 1971 to 2015. The average annual return on the index was 12.1%, which was 1% greater than that of the average mutual fund. This result may seem surprising. After all, it would not seem unreasonable to expect that professional money managers should be able to outperform a very simple rule, such as hold an index portfolio. As it turns out, however, there may be good reasons to expect such a result. We explore them in detail in chapter 11, where we discuss the efficient market hypothesis. Of course, one might argue that there are good managers and bad managers, and that good managers can, in fact, consistently outperform the index. To test this notion, we ask whether managers with good performance in one year are likely to repeat that performance in the following year. Is superior performance in any particular year due to luck, and therefore random, or due to skill and therefore consistent from year to year. So as we can see in table 4.4, it's the rate of return actively managed equity funds versus Wilshire 5000 index from 1971 to 2015. So as we can see, in a few years they were down because of recessions and whatnot. But mostly the Wilshire 5000 index has outperformed the active funds, which is pretty surprising. To answer, okay, so we are asking whether it's due to luck or due to skill, and can they perform year after year, the good managers. So to answer this question, we can examine the performance of a large sample of equity mutual fund portfolios, divide the funds into two groups based on total investment return, and ask, do funds with investment returns in the top half of the sample in one period continue to perform well in a subsequent period? Table 4.4 presents such an analysis from a study by Burton Malkiel, who wrote the book Random Walk Down Wall Street, which I was reading. So yeah, as we can see in table 4.4, consistency of investment results. So successive period performance, 1970s and 1980s. The table shows the fraction of winners, top half performance in each year that turn out to be winners or losers in the following year. If performance was purely random from one period to the next, there would be entries of 50% in each cell of the table, as top or bottom half performance would be equally likely to perform in either top or bottom half of the sample in the following period. On the other hand, if performers were due entirely to skill with no randomness, we would expect to see entries of 100% on the diagonals of the entries, and entries of 0% on the off diagonals. Top half performers would all remain in the top half, while bottom half performers similarly would all remain in the bottom half. In fact, looking at the 1970s data in panel A, the table shows that 65.1% of initial top half performers fall in the top half of the sample in the following period, while 64.5% of initial bottom half performers fall in the bottom half in the following period. This evidence is consistent with the notion that at least a part of the measure of a fund's performance is functional skill as opposed to luck, so the relative performances tend to persist from one period to the next. On the other hand, this relationship does not seem stable across different sample periods. While initial year performance predicts subsequent year performance in 1970s, panel A, the pattern of persistence in performance virtually disappears in 1980s, panel B. To summarize, the evidence that performance is consistent from one period to the next is suggestive, but it is inconclusive. Other studies suggest that there is little performance persistence among professional managers, and if anything, bad performance is more likely to persist than good performance. This makes some sense. It is easy to identify fund characteristics that will result in consistently poor investment performance, notably high expense ratios and high turnover ratios with associated trading costs. It is far harder to identify the secrets of successful stock picking. If it were easy, we would all be rich. Thus, the consistency we do observe in fund performances may be due to, in large part, to the poor performers. This suggests that the real value of past performance data is to avoid poor funds, even if identifying the future top performers is still a daunting task. Concept check 4.4. Suppose you observe the investment performance of 400 portfolio managers and rank them by investment returns during the year. 20% of all managers are truly skilled and therefore always fall in the top half, but others fall in the top half purely because of good luck. What fraction of this year's top half managers would you expect to be the top performers next year? Okay. Okay, so because of good luck. So 20%. So that is like what, 80? So 80 will already be in the top half. 80 will already be in the top half, so that's like what, 120 left. So what fraction of this year's top half managers would you expect to be top half performers next year? So that would be 80 by 200. Oops. 1 second. So fraction of this year's top half managers, I would expect there to be 40%. So yeah. Well, let me check the answers for concept check 4.3 and 4.4. Oh yeah, 4.2 we already did. So 4.3 was 16%, which is correct. Let me see if the first one is correct. $39.549, 39.55, yeah, same thing. It's also correct. And then the fourth one was here, 40%. Oh, wait 1 second. 300 managers. Priority of unskilled manager, lucking in the top half. What? Yeah, okay. 120 by 320.375, okay. Therefore, the 21 very lucky managers in the first year, we would expect 0.375 of 120. 45. Well, I guess I got this one wrong. So I have to. Yeah, done. 4.8, information on mutual funds. So chapter is almost finished. Just a few more pages. Couple more pages left. Information on mutual funds. The first place to find information on a mutual fund is in its prospectus. The Securities and Exchange Commission requires that the prospectus describe the fund's investment objectives and policies in a concise statement of investment objectives, as well as in its lengthy discussions of investment policies and risk. The fund's investment advisor and its portfolio manager are also described. The prospectus also presents the costs associated with purchasing shares in the fund in a fee table. Sales charge such as front end loads and back end loads, as well as annual operating expenses such as management fees and 12b1 fees, are detailed in the fee table. Funds provide information about themselves in two other sources: Statement of Additional Information SAI, also known as Part B of the prospectus, includes a list of securities in the portfolio at the end of the fiscal year, audited financial statements, a list of directors and offers of the fund, as well as their personal investments in the fund, and data on brokerage commissions paid by the fund. However, unlike the fund prospectus, investors do not receive the SAI statement of additional information. However, unlike the fund prospectus, investors do not receive the SAI unless they specifically request it. One industry joke is that SAI stands for something always ignored. The fund's annual report also includes portfolio composition. I think that's the first joke that they've written in this book. That's fun. The fund's annual report also includes portfolio composition and financial statements, as well as a discussion of factors that influence fund performance over the last reporting period. With thousands of funds to choose from, it can be difficult to find select the fund that is best suited for the particular need. Several publications now offer encyclopedias of mutual funds information to help in the search process. Morningstar's web, morningstar.com, is an excellent source of information. Yahoo Finance, Yahoo Funds, Investment Company Institute, ICI.org, National Association of Mutual Funds, Closed-End Funds, and Unit Investment Trust publishes annual directory. The directory of mutual funds includes information on fees as well as phone numbers to contact funds. They illustrate the range of information available on funds. Morningstar report on Fidelity Magellan Fund, reported in figure 4.5. This was ran by my favorite Peter Lynch, which is pretty fun. So yeah. The table on the left, labeled performance, first shows the fund's quarterly returns in the last few years, and just below that, returns over longer periods. You can compare returns to two benchmarks, the Russell 1000 and the S&P 500, in the rows labeled plus minus benchmark, as well as the percentile rank within its comparison on Morningstar category group. Funds with large enough growth stock orientation. The middle column provides, this is pretty like detailed, like again irrelevant sort of stuff, just telling us how to like acquire information on mutual funds. And this is like what a Morningstar report looks like, I guess. Ha. Katie Rush K. Switz, right chart, CFA. She has CFA in her title. It's pretty fun. But yeah. Jeff Feingold. What a name. Oh, he looks like a dork. Why do all these finance guys look so bad? Like all of them look bad. Okay, okay. Jamie Dimon doesn't look bad, I guess. Sort of. Like I guess it's fine. He's like 70 years old. Anyways, let's get back to it. More data on the performance of the fund are provided in the graph near the top of the figure. Line graph compares the growth of $10,000 invested in the fund versus first benchmark in the last 10 years. Below the graph, boxes for each year, shaded in the shaded region of the box shows the quartile which the fund's performance falls relative to the other funds. The shaded band is the top of the box. The firm was a top quartile performer, period, and so on. Table below the bar charts present historical data on year-by-year performance fund. Below the table, portfolio analysis shows asset allocation fund that Morningstar's well-known style box. In this box, Morningstar evaluates style along two dimensions. One dimension, size of the firm held in portfolio is measured by market value outstanding equity. Other dimensions of value growth measure. Which box are they talking about? Morningstar defines value stocks as those with low ratios of market price per share to various measures of value. It puts stocks on a growth value continuum based on the ratios of the stock price to the firm's earnings, book value, sales, cash flow, and dividends. Value stocks are those with a low price relative to those measures of value. These measures of value, in contrast, growth stocks have high ratios, suggesting that the investors in these firms must believe that the firm will experience rapid growth to justify the prices at which the stock sells. Figure 4.5 shade box shows that Magellan Fund tends to hold larger firms in growth stocks, right column. Interesting. So basically top, as higher you go, that's like the value, and like the right you go, that's like growth stocks. Finally, the tables in the right column provide information current composition of the portfolio. You can find top 9 holdings, blah blah blah. Here we have Indian perspective. And then we have the summary. So I don't think I want to do this Indian perspective thing. I don't really find it that interesting. Or maybe I just need a break. So I'll just take like a little bit of a break and then just do this Indian perspective and the summary real quick. Then I'll go for lunch and then come back and then do the questions for this chapter. So yeah, thanks.